Hello, everyone. My name is John Brixon. I'm with Old Capital based in Dallas. Welcome to our panel today. It's how to bridge the bid-ask spread in today's multifamily investment market. And that's an interesting question because we've got a listing broker here who can talk about bid-ask spreads and if they even exist in the current market or if they ever existed in this post-COVID world. And also Joseph Bramante. Joseph is the CEO and co-founder of Tri-Arc Real Estate Partners. So he's a multifamily investor based in the Houston market. And the listing broker that we have with us is Todd Franks, who is Executive Managing Director with Greystone Investment Sales Group based here in Dallas. Guys, thanks for joining today.
Hey, thanks for having us.
Yeah, absolutely glad to be here.
Yeah, so I guess what we can do is maybe just kick off talking a little bit about ourselves and what our role is in the industry. And, I guess I'll start it off. I'm with Old Capital. I'm based in Dallas. We are a commercial mortgage broker, largely focused on financing multifamily properties. A lot of the properties that we finance are ranging in size from $3 million to $30 million in purchase price. I'd say about 60% of our business is Fannie Mae and Freddie Mac, 20% or so is non-recourse bridge, and the balance is everything else. So credit union, bank, construction financing, HUD, CMBS, etc. And George Abreu just joined us. I'll let George get set up here, but we'll go through introductions. And Joseph, maybe tell us a little bit about yourself.
Yeah, great. So Joseph Bramante here in Houston, Texas with Tri-Arc Real Estate Partners. We're a multifamily development, acquisition, construction, and property management company. So we're involved in the full cycle of the multifamily arena. Been around since 2013. Individually, our partners have had career spans of, on average, about 23 years, owned and operated over 47,000 units and about 2.1 billion in assets of experience. So very experienced team behind us and on our way to hitting 20,000 units next couple of years.
Great. So Todd, maybe tell us a little bit about yourself and Greystone.
Sure. I started brokering about 20 years ago in 2000. So, it's been a little while now. Seen a couple of cycles and, I've been involved in over 1.7 billion in transactions. I have no idea the number of transactions that is. It is in the hundreds. Started my own firm in 2014 after working at a boutique firm for about 14 years and running it and wondering why I didn't do it myself. It's been successful. We affiliated with Greystone in March of 2019, and it's really been a great partnership. We brought on the DUS lending platform as well. We don't do a lot of it out of this office, not as much as Old Capital does anyway, but we specialize in investment sales, mainly B and C class properties across North Texas, Oklahoma, and other secondary, tertiary markets in Texas.
Well, great. Well, thanks, Todd. Seems like you guys are having a great year here in 2020, despite the disruption in the market. So congrats on that. And George Abreu, thanks for joining us here. Maybe give a little bit of background about your group.
Absolutely. Sorry, I was joined a little bit late there. So I started in real estate investing about 16 years ago. Started in single family and then started working myself up into smaller multifamily till finally about 4 years ago turned all my focus towards large multifamily B and C properties. My firm is Elevate Commercial Investment Group. I'm the CEO, and we've been just growing our company, our systems, and our portfolio, and looking to get to 10,000 doors and eventually that 20,000 that Joseph talked about.
All right. Well, great. Well, I guess first question or first kind of item to talk about here, just to kind of kick things off. The title of this panel is How to Bridge the Bid-Ask Spread in Today's Multifamily Investment Market. And, I think when these panels were put together by Crittenden, it might have been a month, 2 months, 3 months ago. And obviously COVID happened and everyone was expecting a pretty big disruption in the market. And, there may have been a disruption immediately after the months after March. But I guess my first question would be for Todd. And Todd, is there even a bid-ask spread in this market? And if there's not, was there ever a bid-ask spread in the months after COVID?
There's always a big bid-ask spread. That is just, it's the nature of the beast. It's been happening since I've started brokering, just like value add has been a sales point since I started brokering. I actually found an old file recently that I was going through when I first started brokering, some training stuff in there, and I went back and looked at it. And, we were saying a lot of the same stuff we're saying today. So it's just prices were a lot lower and cap rates were a lot higher. But yeah, usually there's a, some sort of gap to be bridged there. Especially mostly it's situational, of course, off-market deals. You're going to have it to contend with that a little bit more because, I think if you fully expose a property to the market and you do list it, you go through the proper marketing process, the market speaks and, usually the seller's confident at that time that, hey, this is the price. If their expectations were maybe a little bit unrealistic, they learn that through that process. That helps, begin to bridge that gap a little bit. So that would push it down on the sell side. On the off-market deals, again, if you're dealing with, just one buyer and one seller, you're just going to have to do a little bit of work. And, there can be one. I will say, to your point, John, is that, we've been, I think, extremely fortunate here in the Dallas-Fort Worth area, where there's still just a lot of demand for multifamily. I think kind of what drove that was all the product being pulled off the market at the beginning of COVID in March. There was a major lack of inventory. No one was buying for a while. All the conversations at the beginning were like, hey, what's the COVID discount? Why would I buy this thing for what I bought it for yesterday? On the seller side of the transaction, it was like, why would I sell it for a discount? I'm still collecting the same income. Interest rates have gone down. My operations are doing well. We were worried as brokers that was going to freeze up the market. There'd just simply be no transaction because, obviously the way that plays out is, that gap gets wider and harder to bridge. But I think with the lack of product on the market and decrease in interest rates, it really, buyers really stepped up. As long as you can get the loan, as you can generally sell the property unless there's some kind of underlying fundamental problem with it that, gets identified late in the game. But it's like I said, we've been fortunate here in Dallas-Fort Worth. There hasn't been a big gap. I could give you some deal stories. We brought out probably, I think, the second or third property to hit the market post announcement of COVID. I think that day really starts sometime around March 11th when, Tom Hanks announced that him and his wife had COVID. And I just had a seller that was like, look, I told you when I turn 75, we're going to sell this deal. And, let's try it. If it fails, we'll go back to the drawing board and we'll do it again another day. I had sold them the property 12 years earlier. So I, was comfortable with that. We're going to spend a lot of time, effort, and energy marketing it. Had to shift our marketing strategy a bit. Of course, you have to, do the virtual tours and the drone videos. And, we do interviews with the manager and try to ask all the questions that we can think a buyer would ask. At the end of the day, the result of that was, we sold it for over list price. And, buyer was happy, seller was happy, because interest rates came down during that time. Starting out, we thought we'd be achieving about a 75% loan to value on that sale, and the buyer achieved an 80% loan to value. at a very attractive interest rate. So, we've been pleasantly surprised throughout this time. I think, everyone is trying to figure out what's going on with the markets, from, the stock market to the residential market to the commercial real estate market. But multifamily, Dallas, Fort Worth, we're not having a lot of problems moving that product.
So Todd, as a follow-up to that, I would ask you, if you're running through a situation where it's a fully marketed deal, goes through a four-week marketing process, you have call for offers, you have a whisper price that's put out there, say it underwrites for 75 to 80% agency financing, you set the whisper at 90,000 per unit. Are you seeing properties go under contract at 100% of whisper or list price, 105% of list price? And is it the same as it was? Are you hitting your whisper kind of the same way you were pre-COVID versus post-COVID? Has that changed at all?
It's about the same. I feel like we were struggling a little bit kind of just pre-COVID going into early 2020. Before COVID hit, there was a lot of product on the market. Buyers were starting to get a little bit nervous that they're overpaying. They were adjusting their underwriting standards. I know, some of the major syndicators, and we have a lot of them here in Dallas. I really think we're the hub for the, real estate guru syndication type investors. And those folks were changing their underwriting, and we weren't seeing them step up to the table and be as competitive as previous years. So honestly, it was slowing down a little bit. I think what helped us again was, the inventory being pulled off the market and still having motivated buyers out there, and they had, they had to buy something. And, it just got more competitive with less product, and there were less buyers, but there was significantly less product than there were less buyers.
And
I would ask you, Joseph. So,
yeah,
what are you seeing in the Houston
I'll
market?
jump in. So, no, just a slight correction. I wouldn't say that Dallas is the hub of syndication, since a lot of those guys came from Houston, and how Dallas just happened to be really hot right now. So, just slight correction there. But the other thing that we are seeing, just to piggyback on that original question. So your comment, the terms are similar, but one of the big terms that's really messing things up on the buy side is the escrows. We're under contract for a 440 unit portfolio, and it's two properties, and we've got 6 months of principal, insurance, interest, and tax escrows on the Freddie loan. So it's, you have to factor that in. That money doesn't come from nowhere, and so it's really challenging to get those whisper prices when you're having to build in all these escrows up front for the closing docs. So, but in regards to Houston, Houston is doing well. I'm not sure if it's a good thing, but we lead the nation in evictions. So we're not. There's a moratorium, but somehow we are managing to get people out for. There's other reasons that we've had this situation where we had to do an eviction where it wasn't a non-payment, it was a behavioral issue. There's actually clauses on leases where you can get them out for behavior, but regardless, overall, I'd say Houston's doing well. I'm sure George would agree. We had a huge absorption, like 19,000 units just in the first half, which has kind of pushed our occupancy down to around 88%. But overall, our effective rents are staying relatively high. They just in the past few months, they started to dip down a little bit. But most of that's going to be on the Class A market. Those guys are just getting destroyed right now. B and C has, like most recessions, has been relatively flat. They didn't really see much of a decrease. They just kind of, we just hold what we got. And then once things start getting better, they'll start to increase again. But overall, I'd say Houston's, especially when you picture Houston, people forget that we just got destroyed with the oil collapse. People forget that oil just tanked a few months before COVID, and then we got hit with COVID. So it was really a double whammy, and we're still doing strong. So Houston's a very resilient economy, and that's why investors continue to come here.
Yeah, I think early on, in the months immediately following COVID, obviously energy, oil prices went negative for that one day back in April. And I think there's a lot of concern about Houston being hit especially hard, given the large concentration of energy jobs. But I guess you're saying that at least at this point, you guys haven't seen a large uptick in collection or I guess vacancy or bad debt or anything along those lines.
No, and bad debts, I imagine one of those things a lot of people are holding near and dear to their heart, and we're just gonna, we're gonna see the cards here soon enough once all the eviction moratorium is released. And that's one of the underwriting factors that we do on deals is we're increasing our bad debt up to over 3% on that first year on deals, because we know it's not going to be pretty, and it's one of those things that nobody's really talking about. But bad debt, non-delinquent that's building up, it's going to come to fruition here very quickly once that moratorium's up.
Yeah, I think I would agree with that. And George, I know that you're active in a number of different markets. I know you're in Houston, and you're looking at a portfolio or at least a property in South Dakota. But have you been submitting offers post-COVID, and are you seeing any kind of difference in what the target pricing is, and then where you're actually coming in on your offer?
Yeah, I'll kind of try to weigh in on everything that was just talked about. So I agree with Joseph as far as Houston. We've been able to continue to push the needle. Collections, we've had to work pretty hard on it. The properties we have are your true workforce housing, and we've had some residents that lost their jobs and whatnot, and we're helping them either find new jobs. We've also helped them. There's a lot of local grants and rental assistance. So I think we're due about $40,000 in the next couple weeks that we got from rental assistance. But I mean, our occupancy, we took it from pre-COVID. Our portfolio occupancy was high 80s, and now we're sitting as of today at around 94%. And then as far as markets, we are submitting offers. We're being very specific of what markets, and really dialing into the data and seeing, okay, which markets have fared fairly during COVID, and I guess can be resistant to something, some type of pandemic like this. So we're not, as far as Dallas goes, I had already started looking at other submarkets 2 years ago, because the pricing in Dallas just wasn't making sense for me. I get it, it's an amazing economy, and for the most part you can usually hit your rent bumps, but when that pricing starts getting to a certain point, especially like if I'm looking at a C class that I know is in a rough area, maybe in a C- area, and it's going for 100, 110 a door, I don't know, I kind of want to stay away from that when I know I can build it for just a little bit more.
So George, which markets are you guys looking in, and where are you seeing where there might be value, and how have you decided on those markets?
Yeah, I'm still a huge fan of Houston. One, the way it's performed. I do think you need to be very specific on the area of Houston. So we're definitely staying there, looking for more deals. We're exploring different markets, like you mentioned South Dakota. We looked at the data of South Dakota and the fact that it's more diverse than people think, and then the way it fared during this whole pandemic. So we're looking for those type of markets, the ones that are kind of up and coming.
Yeah, it's interesting. This is probably the only multifamily panel ever where you have not just one person that's working on a transaction in South Dakota, but two people, because I'm actually doing a 223F HUD refi a property in Sioux Falls.
Oh, wow.
And I know your property is in Rapid City. It's the other side of the state, but Sioux Falls is actually a great market. There's a lot of population growth there. A lot of people hear Dakota and they think it's North Dakota and they think it's a big energy concentration, but there's actually no energy at all in South Dakota. But it's performed well. It's a good property, and it'll be a nice cash out refi for the sponsor. So
yeah, I think we just landed one in Sioux Falls.
Okay, well, that's great.
Been working on one.
I'm on the South Dakota bandwagon. There's room. So, well, good. Well, so I guess we talked a little bit about offering, and Joseph kind of touched on it a little bit. But how has your underwriting changed, if it has changed, in the current market compared to where we were at the start of the year? And asking for George and Joseph here, and I guess maybe Todd, if you have any thoughts on what you're seeing buyers doing on their underwriting.
Yeah, sure. So underwriting has obviously changed a good bit. It talks about the pref or the escrows for the lender. But we're actually seeing pref equity as well being very active right now. Or the deal we're doing is we've got a 40% pref equity slug in there, and they got their reserves up front as well. So you have to get really creative because the leverage isn't always there, because sometimes the lenders are a bit more cautious because of COVID. So they're going to either put more escrows or going to decrease your leverage, one of those two. The other thing is, I talk about higher bad debt. We're also going in with higher vacancy in that first year. We're holding the rents flat just as a precaution. I think it's, nobody's really planning on increasing the rents in this upcoming 12 months. It's because we don't really know what to expect. We're also holding them for a little bit longer just to kind of push through everything. We feel like, one, you can get better terms on the debt if you have it for a longer hold. And two, you'll be in a kind of a better market. So if you did have any kind of overpayment on this, you would have been in a much better market, hopefully in the 7 to 10 years whenever you're exiting. The other interesting thing, though, not just on the underwriting side, though, but the whole due diligence process has changed. Like for us, we had to quarantine our entire walk staff for 2 weeks before doing the due diligence on these 440 units. And then even on top of that, we only did about 20% of the units because we didn't want to, A, put our team at risk and at exposure, and then B, also expose our residents, because then you get this whole liability thing. So it's completely changed the whole due diligence process as well, which I thought was, hopefully nobody has to deal with that going forward. Hopefully you got the vaccine is coming out soon and it'll be a non-issue. But there's little nuances, all these weird things that you don't think about that have changed with the acquiring process. Kind of like Georgia, we're also looking in other markets. We feel like tertiary markets are going to be a bit stronger than your urban markets, because you've seen, the high dense markets are not really favorable when you're trying to combat a disease like COVID, versus these tertiary markets are less dense. They tend to have less exposure and less COVID rate.
And you can work remotely now too, I guess. That's another thing, is that, a lot more people working remotely, so you don't have to be within, 20, 30 minutes of a job center necessarily.
Yeah. And we're also seeing just kind of, I think we talked about this earlier, but just the opportunities to buy well. There's some opportunistic buying that's going on right now, because nobody's really selling unless they have to sell right now. I mean, if you're selling, it's because your loan's about to mature and you don't want to refi or whatnot. But otherwise, most people are going to wait until after COVID, because they don't want to give that COVID discount that everybody's been talking about. So if you're a buyer, if you see some hit the market, especially now or previously in the last couple months, there's a good chance that you had some pretty good leverage some negotiating leverage to get a good deal.
And Joseph, you mentioned, so your 440 unit portfolio, you guys you have a Freddie assumption, but then you're doing pref behind that?
No, it's new debt. So
new debt.
All new Freddie with pref on top. Had to be, the terms that we had to agree to were very much in our favor, because Freddie has very strict rules on how you do that. We're also doing we're also doing a very large renovation in Houston. We got a 220 unit property that we're spending just over 37,000 a door renovating. So it's a massive, massive renovation. And we ran into issues with it recently because of COVID that we weren't expecting. One, lumber prices are going through the roof because all the mills are shut down. So we've had to basically pause the renovation right now because our change order for the increased material cost was going through the roof. Then the other is the appliances. Like we've got units that we can't get appliances into. We've had appliances on back order since June. So if you're going to buy a property right now and your plan is to go ahead and do, change out the appliances, you might want to rethink that because there's just a huge back order right now nationwide for these especially these basic level appliances that we so commonly put in our apartment units.
Yeah, no, that's a good point. And I've heard the appliances especially are problematic. Somebody might have a unit where the refrigerator goes out and the resident, all their food spoils. It takes 2-3 weeks, to get into a refrigerator in, and they have to let them out of their lease because they haven't been able to provide them with a refrigerator. So that's actually, the supply chain is causing some major issues, I think, for all over the economy, but I think even in multifamily.
Yeah, the good news is it's starting to correct itself. Mills are coming back online, so we're going to see things go down. I think over the next couple of months, it should all dissipate, but it probably will be around here until at least the first or if not early second quarter.
Sure. Yeah, and I think on your portfolio that capital stock that you're talking about is interesting. And I was working on or I am working on a financing and acquisition on a property in Fort Worth, and it's 2018 construction, 270 units, and the syndicator is buying it, and he was actually under contract pre-COVID and kept it under contract and gotten extensions, just because of COVID, obviously, and scheduled to close in October. And when we originally were putting together the financing, his thought was, well, I've got to raise $10.5 to $11 million here from my network of accredited investors, and this might be a challenge to raise the full 10.5 to 11 million. So they brought us in to arrange not just the debt, but then also to look at equity options. And we reached out to a number of different groups, looked at doing joint venture equity, where one group would come in and bring 90% of the total common equity, or preferred equity, where a group would bring in, about half of the total common equity required. So of the 10.5, 11 million they need to raise, the pref group would bring in 5 or 6 million, go up to 90% of the purchase price. And then we were going to have a Freddie Mac floating rate loan up to 75% of the senior. And what ended up happening is we had some really good options on the pref and had a really good term sheet. We were about ready to move forward with the pref, and the pref provider was about to go to investment committee, and the sponsor last minute just said, you know what, I'm actually getting really good interest from my accredited investors on our capital raise here, and we should actually have no issues raising the full $10 million just from our accredited network. And so we ended up just pulling the plug on the pref and just doing a straight Freddie floater plus common equity. And so, I guess with that, I would ask the question for Joseph and George, since you guys are out in the market, you're talking to accredited investors, but then maybe also talking to institutional equity or pref equity or joint venture equity. What's the equity raising environment been like for you guys, both on the private investor accredited side, but then on if you're looking at pref and JV equity, what are you seeing there?
Yeah, I'm seeing a lot of pref, and I gotta shake my head at that story. I think that guy made a huge mistake. I mean, if I had a lot of interest in my accredited investors, I would at least reduce the amount of pref. We're getting 85% of the cap stack with the pref guys because the returns are just through the roof once you can refi and cash out that pref equity guy, the class A, your regular investors. Returns go up, which as the sponsor is great because you can justify a higher promote on it as well, because it's a very, sophisticated kind of strategic maneuver to execute that well. But anyway, on the prep side, we're seeing tons of it. We had a whole option of guys to choose from, and we chose one for our Victoria deal. And then what was the second part of your question?
Are you guys looking at, well, I guess the second part of the question would be your accredited investors, because obviously if you have pref up to 85%, then you've got the remaining 15% as the common. And so, and I think, my sponsor, their concern was that their accredited investors wouldn't be comfortable or wouldn't be okay with the pref ahead of them in the capital stack. And so what's kind of the appetite then with accredited investors?
So how we addressed that was with the reserve. So we've got a full year of pref equity reserve at closing on our deal. It's almost $1 million in reserve. And so that kind of gives them some comfort, because that is absolutely correct. Is that in a typical deal, if you don't have that reserve, if there's any kind of shortfall in the cash flow, then that common investor gets, they take the brunt of it. But by having that reserve, and we've showed them how all the cash flows work out, that that reserve kind of buffers them from any kind of inadverse shortfalls in that cash flow. So I think if you've structured it well, if you put enough reserves in there, also we've really kind of pitched that, really you look at the stock market, which isn't something we normally look at when we're selling a real estate deal, but the NASDAQ, the S&P, the Dow 500, S&P 500 and Dow, they're all basically back at their peak like they were in March. So nobody buys high and sells high in stock. So if you were going to invest in stock, your opportunity was back in March, April, May. Now their opportunity, you need to switch back to multifamily. And then there's also, we always show them this chart. There's a chart that shows the delinquency rate for the different asset classes, meaning industrial, retail, multifamily, and lodging. And, retail and lodging just got absolutely destroyed. Everybody knows that. And you can see it on those charts. You can see what percentage of them are 30 days late, what percentage of them are with the special servicer already. And really what the indirect message of all that is that those investors who were on those deals are no longer going to be on those deals. They're going to come back to other assets like multifamily, like industrial, because they survived this pandemic the best. And so when you've got more money chasing fewer deals, it's going to drive the prices up. So when people start to understand the macroeconomics of everything that's at play, as well as the different escrows that we've built into our deals to make sure that everything goes smoothly, they get a lot more comfortable going into these deals in spite of the current COVID situation.
Sure. And Todd, what are you seeing from the listing broker view? Most of your buyers, how are they capitalizing deals any differently in the current environment than they were at the start of the year?
I don't know for sure, to be honest with you, how they're capitalizing their deals 100% of the time. We have seen several instances early on in the pandemic where investors that came in and they did lose their equity, and their equity sources or equity source, and had to retool. And obviously the reserves were a concern as well. That hit some folks, especially when we were under contract pre-COVID, and they just popped those on them. And it wasn't like, well, you were under contract and the loan app was in, everything's okay, don't worry, you're grandfathered in. It's they were due for everyone. So there was definitely a bumpy road at the beginning, but for the most part, everyone got through it. I'm not seeing, the underwriting difference that I'm seeing is it's slight. They're not increasing rents obviously over the next year or two coming in. Rents are staying relatively flat. Underwriting a little bit more bad debt. I think coming through this, the thought is, hey, when all the subsidies stop, what's it going to look like? How are people going to be able to pay rent? I don't syndicate, but I do own 5 properties in Dallas and in Arkansas, and we've had to get creative. For example, if residents, in Arkansas, I'll tell you, it's crazy. I thought the secondary, tertiary markets we're going to feel it more than we are going to feel it in Dallas-Fort Worth because we have a very diversified economy. You know, we're not relying on any one particular industry to support us. So, but the properties that we have in Fort Smith, it's been unbelievable. We've been 100% occupied for probably 6 months now. We're actually going to refi that deal because the operations are so good and interest rates are so low. But we've had to get creative. Folks that couldn't make payments, of course, you know, you hook them up with, you know, some sort of program that will help them make payments. But, you know, one that we ran into, it's like, well, they have to at least have, you know, made a partial payment on their rent in order for us to provide any sort of assistance. So I was like, wow, they're going to get so behind. You know, you've got a, you know, an unemployed father. You know, the mother is a waitress, which that industry is awesome right now. I'm sure bringing income, they're just having a hard time, you know, feeding the family, let alone paying rent. So, you know, we actually said, okay, what if we pay part of their rent? And we have them doing work around the complex of like, hey, you know, let's get up in the morning, pick up the grounds, you know, help out. And, you know, we'll pay them and they can pay that as partial rent. And then, you know, they get the rent subsidy because I'm like, look, they're going to get so far behind. There's no way they're ever going to be able to make up all these payments, even if they do get their job back. You know, they're already, you know, so far behind, there's no way to catch up. So, you know, I'm kind of off track there on your question, but the, you know, so it depends, you know, where you're at, and who you're dealing with as to if they're going to get the deal done. I mean, you know, I think, folks that we wouldn't, for example, even, you know, advise our clients to go under agreement with, someone who is, you know, does not have a lot of experience raising capital and doesn't have a very proven track record, you know, during this time. If there's any question, they'd be able to, you know, raise the capital. We just simply wouldn't recommend them as, you know, awarding them the deal, even if they were the top price, because, you know, the likelihood of that deal closing goes down substantially. So, you know, we just want to know that, you know, one, they either have the equity they can show us. We're selling a lot more to funds, you know, individual wealth, you know, people that the money's there, they don't have to go out and raise it. And, you know, if they do, you know, like I said, they're going to be very experienced and it's not going to be a problem for them to raise yet.
Yeah. Or if you're a listing broker in DFW, you just require them to put up 2% of the purchase price, non-refundable day one. That often helps with certainty of execution on a.
We do that too, but you'd be surprised that does fail.
Yeah.
You know, so and everyone always fights over the earnest money. Everyone, you know, that is something that I don't think gets talked about a lot. Is, you know, it's great to have non-refundable earnest money, but you know, it's not necessarily, you know, when the buyer fails. They're just gonna throw their hands up and say, you know, keep my 2%, I'm out of here. You know, there's gonna be some sort of argument on both sides to keep that money, and it ends up being messy, and you just don't want to get in that situation.
Right. Well, actually, I'm glad that you brought up, Todd, these different programs and how you guys are maintaining collections. And this really is, and I've heard, I think Joseph and George are kind of touching on this too, but you know, these different programs that are available to assist with rent. And I guess for Joseph and George, do you use third-party management or do you self-manage? And then these programs, I mean, are they pretty widely available, or is it just kind of a hope and a prayer that you can find someone that will help your residents with paying rent? Because I think, you know, part of the challenge is you know, the residents can apply for these programs, but I think they also have to prove out that, you know, they're making the best effort to pay their rent or get unemployment or find employment. And so what's kind of the process been for, you know, Joseph and George, for people that do fall behind and you know, go with these programs?
So we have management in-house, and I'll tell you, first, I don't do operations, so it's I don't have all the privy into that, but what I do know about it is that one, you can absolutely help the resident in completing the application. So we've got our whole list of who all the different charities and rental assistance companies are, and then we'll sit down and work, especially for the ones who are behind. Our managers will work with them, and they'll help them fill the form out, sometimes even filling out for them, so that we can, get that submitted and get the money in, because ultimately it really is in our best interest to make sure that they're making those submissions. And but as far as I know, it's really just kind of having that information, that knowledge as far as what the assistance programs are in your market, because every market's going to be different. I'm very fortunate that both of my partners have been in Houston for 30 years, strictly on property management. So we already had the list ready, and whenever COVID came out, we were front in line to get that money. And then of course you had all the EIDL money and whatnot that your sponsors and owners should have been applying for. We got over $700,000 of funds from those different programs, or just from really the EIDL, that could really go a long way to help the properties.
I actually haven't heard a whole lot about multifamily sponsors going through the EIDL program. I think a lot of the management companies did PPP, and they would usually just pass that through to the actual owners of the properties. But how does the EIDL program, how do you qualify as a multifamily owner, and what is that process?
It's been a minute because I did that right when it happened. The qualification process, because there were two different, right? The PPP was for your salaries and your wages. And for us, I believe we did the EIDL based on the lost income that the property was seeing. And so that was, you just fill out the form. It was, actually, we already paid off one of them, because we had one property it was really a unique situation, that this one property we had negotiated a holdback, basically a built-in refi on our loan. Once we hit a certain debt coverage, we automatically got extra couple $100,000. Well, sure. When the LIBOR rate tanked, we triggered that amount, so we got several $100,000 back, and then we got the EIDL, and we're like, well, we don't need the EIDL. But then the problem with the EIDL is you can't do distribution. So we were sitting on like $500,000 of money, and we couldn't get it out to our investors. And the actual repayment process of the EIDL was more burdensome than the application and getting the funds, which was ridiculous. So I think we might have been one of the first in the country to actually pay it back.
Right. So I guess for you guys, maybe it was more of kind of like a boot or a belt and suspenders type situation, where you knew the EIDL was out there, you could apply for it, and so you said, what the hell, let's go for it. And
you should always apply for everything you're able to apply for.
Yeah, absolutely. George, I guess what are you seeing on the collection side, and just different programs that are out there and available for tenants that are falling behind on rent?
Yeah, in Houston in general, so our co-GP on the portfolio down there, they have in-house, and the rental assistant has been amazing. Like every time a program comes out, our team on site, so usually the ones that the day it comes out, you've got to apply for it, and it runs out pretty quick. So our team has been on top of it, and then they make sure that the residents that need it sign up for it. They just did, I think it was a city one, that they just supplemented it with more funds. Yeah. So we got the residents to apply for it, and it's really we've been on top of it, and it's helped a ton.
Yeah, it's more so just being proactive with those types of programs. You have to go out and find them. They're not going to just come to you.
No, yeah.
I guess it would be. Okay. Well, shifting back to just sales activity that we're seeing in the market, and this is a question for Todd, but Todd, how do you think investment sales activity in the DFW market? How does it compare? How does 2020 compare with 19? And then do you think 2021, are you expecting higher, flat, or lower sales volume across DFW?
I always hate predicting that sort of stuff. It's hard. But currently, just in-house, we should have a record year, knock on wood, if everything plays out. That's an escrow and what we've gotten done so far this year. So we've been very fortunate. I don't know if I agree with Joseph of like, hey, you're only selling if you have to right now. I think we have a very compelling argument for selling now. Interest rates are at an historic low, which that raises the price, of course, and
interest rates are going to stay low until 2023.
The last time I predicted interest rates, going up like they should have for about a decade, I've been wrong. So I'm not going to try to predict interest rates, and anyone who can, should be in a different, line of work, because you'd make a lot of money if you know how to predict interest rates and treasuries and stuff.
Not predicting. The Fed came out and said they're keeping them down until 2023.
Does the Fed control the treasuries?
Yeah, they do not. The treasuries, I mean, the yield curve can certainly steepen. And if it does steepen, that would impact agency rates.
I don't think the Fed controls spreads either, last time I checked. So, it's great that the Fed can say, like, they're going to keep prime low, but that does nothing for the family industry, for their short-term loans for businesses. Like I said, it's a compelling argument right now to sell. Operations are not down. There's a lack of product on the market. When inventories are low, like let's say on stuff like lumber, it sells for more. You've got low inventory, historically low interest rates. You've got buyers still looking to buy. I know a lot of buyers want to, believe that there should be a COVID discount, but we're just not experiencing that, in my world. I'm not saying that I broker all over the country, so I doubt that that's true everywhere. But that's, what we're seeing. And I don't think it's a bad time. If you are contemplating selling and you are reaching your investment goals for your investors, why wouldn't you right now, or even refinance, recapitalize in one way or another?
I would say in the last about 3 weeks, I've seen a ton of deals come online, and the pricing is not discounted whatsoever.
Yeah, the product has hit the market. There's been a wave of pent-up product, and it has hit the market. I totally agree with you, George. In the last, 2-3 months, it's it's going to happen. So.
Yeah, and when I was referring to the discount would have been on stuff that was going to sell or hit the market like 2-3 months ago. So obviously everything that's hitting market now, is going to trade next year. It's not trading now, and COVID will be behind us. So sure, if you are looking at selling now, go for it. But those who were looking at selling a couple months ago, they were selling because they had to.
Well, and on the buy side, maybe where there's a little juice too, it's like what I'm noticing is that, you can't collect late fees right now. There's other income that's missing from the P&L. So again, you have these historic low interest rates and, other income, late fees, people aren't moving as much. Application fees are not in there. You've got we're seeing a trend of, reduction in that sort of other income. And, that will come back. It's not going to go away forever. And, so you get a little bit of a discount, in terms of that.
Yeah, I mean, I think if there's anything right now that's really holding back listing activity, at least in DFW, and I'll at least partially take the blame for this, as we were doing a good amount of these loans, but it's these damn yield maintenance penalties. And everyone thought, 2-3 years ago that, getting fixed rate debt on your property was a great idea and a great opportunity. And now it's a lot of properties are just stuck right now with yield maintenance. So,
weren't you predicting the rates weren't going to go down any lower?
Yes, exactly.
Think they'll go negative?
I don't know. We'll see. We're trying to negotiate those LIBOR floors as low as possible, and no one. I haven't found a lender yet that will allow us to remove the LIBOR floor. So, not too many people willing to stick their neck out and say that rates won't go down any further.
Yeah.
Well, good.
No.
Well, guys, I think we're getting pretty close to wrapping it up here, but it's been an interesting year. It's been an interesting last 6 months. I think we're all pretty fortunate to be in the multifamily industry, and we're lucky that we're not hotel people or retail or even office investors. And so, I guess with that being said, given where we are in the market, maybe just kind of a last thing, but why is right now, sitting here in September of 2020, why is multifamily, or what is the compelling reason to invest in multifamily at this point in time?
I can go ahead and run with that one. I think it's become pretty obvious, and COVID has made it even more obvious that multifamily is one of the best sectors, if not the best in real estate. It's shown that through collections, and people still need to live somewhere and are willing to do what it takes to pay for that, pretty much. And you can see it through, you spoke about equity. There's a ton of equity out there, and a lot of it is looking to come into multifamily, and it's for that very reason. So, if anything, once COVID's past us, I see even more attention towards multifamily. And as far as the pricing, there's a lot of different things that are gonna determine the values and where we're gonna go with that. But yeah, I'm all for multifamily.
And I would agree, and I think anytime you've got something that's fulfilling a basic need, which multifamily is, and we witness this, and the government says you're on lockdown. Everybody, it's great when you've got the government telling your customers to come and stay in your business, and it was even better when they said that they're going to pay their bill for us. So I think that definitely multifamily showed its resilience. I know a lot of us were nervous. At least I was very nervous in the beginning because nobody knew how it was going to play out. And I think that one, the economy showed that it was more resilient than we thought it was. But two, it also exposed a lot of weaknesses in the other industries like retail and lodging that people had never even thought about before. And I think that now it's going to change the whole conversation. And now, multifamily, like Jorge said, been kind of put on this pedestal. We're the favorite child right now, and what's going to happen when you're the favorite is that you're going to have a lot of money chasing you, and it's going to be very difficult to find deals and buy deals because you're going to have guys with deeper pockets who are willing to take a lower return on something because they're buying it for that security. And so I think it'll be interesting to see how the next couple years play out. I think the brokers will be doing well. They'll experience some really high appreciations in purchase price. But I think investors might, I think some of the yield might be dissipating.
Yeah. I think B and C class workforce, housing is, still going to be the darling. If you're purchasing today, the recommendation that I would make to you is that, hey, it makes sense on the numbers in place today. We don't know when value add and increasing rents are, when that's going to come back. If you can sit and hold it and, have it make some money for you and you can do a good job as the operations are now, great. Hopefully there is some value add in it. But like I said, when you're going to have the opportunity to realize that, is anyone's guess. So it's a great product type for every reason that Joseph and Jorge just said. Of course, I'm a big proponent fan. Not only do I sell it, but I own it. So
eat what you cook.
Yeah, exactly. So I'm a big believer.
I think also one other thing that was exposed was the necessity for us to bring our supply chain home. I think by having such an international focus, on China and everything, I think that now you're going to see a bigger push to do stuff more in America, which when we do stuff here, it means higher wages, and it means higher wages means higher rents and higher valuations. But I think it'll all kind of it'll play out well for the multifamily space.
Yeah, and I think I would cap it off with being that I am a debt guy, my personal bias for why multifamily is going to be that you get the best financing in multifamily, and you get the best financing because you have Fannie Mae and Freddie Mac in the market. So there's no Fannie or Freddie for, everyone loves industrial right now, but there's no Fannie or Freddie for industrial. So you could own a $2 million industrial property in Fort Smith, Arkansas, and that's great, but your only source of financing really is going to be local bank or credit union. You own a $2 million multifamily property in Fort Smith, Arkansas, you can get a Fannie small loan on it, a Freddie small loan on it. And I think what's largely carried the multifamily in this market, post-COVID really has been how competitive the agencies have been, and interest rates going from, low to middle fours range down to the high twos has had a really big impact. So, if you can get 70, 75, even 80% financing at 2.8 to 3%, cash on cash will be really strong. And this is my hot take of the panel, but I think cap rates will actually go down, simply because if you can finance newer construction, quality multifamily in a strong market at 75, maybe even 80%, cap rates just have to go down because the cash on cash is just too strong. So,
hey, I'd be curious to get your take on if Fannie and Freddie are taken out of the conservatorship. Sorry. What do you think that would do to rates, and if it became more of like a CMBS product?
Yeah, I mean, that's a whole other conversation, and we could talk for another hour about what the impact would be if that happens. But what I would say is, Fannie and Freddie they were private up until 2008, and just if they go private, it doesn't mean that the government guarantee on their bonds is necessarily going away. So as long as there's that government guarantee or partial government guarantee on Fannie and Freddie debt, and multifamily continues to perform really well, and there is a strong demand, at the fundamental level, just at the ground level, multifamily, the dynamics are really strong. And so whether Fannie or Freddie are owned by the Treasury, or if they're owned by private investors and they go public as they were pre 2008, I think they'll still be there, and I think it'll still be a source of strength in the market.